Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was the continued strength of this rally, with stocks reaching new record highs on a powerful combination of growth and earnings momentum. The S&P 500 climbed to all-time highs this week, capping off a roughly 10% monthly rally. Fresh economic data confirmed that the US economy is accelerating, while corporate earnings growth coming in healthy. What's especially encouraging is how broad-based these gains have been, with smaller companies also participating, which is a sign of improving overall market health. For our portfolios, this environment continues to reward our focus on high-quality companies that can benefit from both rising earnings and expanding valuations. A standout moment this week came from Alphabet, whose shares jumped over 10% after delivering exceptional quarterly results. Revenue reached $94.7 billion, while cloud sales topped $20 billion. The numbers tell an important story. AI isn't disrupting Alphabet's core search business, it's actually strengthening it. And the rapidly growing $460 billion cloud order backlog points to years of demand ahead. This reinforces our conviction in owning leading technology platforms that are successfully turning AI innovation into real, durable revenue. We also saw an important development in the AI credit markets this week. Demand for AI-related financing remains very strong, but investors are becoming more disciplined, paying closer attention to deal quality and structural projections. Large technology companies are stepping in as anchor tenants and financial backstops, which is helping support the investment-grade opportunities. This is a positive sign of maturing investment cycles, where capital is beginning to be deployed thoughtfully rather than indiscriminately. Now let's look at what drove our performance over the past week and why we remain confident in our current positioning. Visa was our top performer last week with a 7.57% gain. The company continues to benefit from sustained strength in global payment volumes and resilient cross-border transactions. There's a powerful long-term shift underway from cash to digital payments, and Visa sits right at the center of it. Their high-margin, asset-light business generates reliable cash flow even when the economy sends mixed signals. We own Visa because it represents exactly the kind of compounder we look for in a dominant franchise with global reach and predictable earnings power. The energy sector led our performance, with integrated oil majors like Exxon, Chevron, and ConocoPhillips all delivering solid gains. Crude prices stabilized this week and supply-demand dynamics improved, allowing these companies to keep generating strong free cash flow. They're returning meaningful capital to shareholders through both dividends and buybacks, which is a sign of disciplined management even when commodity prices fluctuate. Energy exposure also provides our portfolio with valuable diversification and a natural hedge against inflation, which is why it remains a strategic part of our allocation. Our size strategy was once again the standout performer, with large cap holdings continuing to outpace smaller companies. Mega cap firms are benefiting from financial strength, global scale, and the ability to invest in transformative areas like AI and digital infrastructure. They're also better equipped to navigate complex policy and regulatory environments than smaller companies. While we remain mindful of valuation and concentration considerations, the consistency of large cap leadership reflects real fundamental strength, and our positioning in established market leaders continues to deliver results. Looking ahead, here are the key events that we're monitoring that could shape markets in the coming week. Tuesday, May 5th brings the ISM Services activity report, which gives us a snapshot of the part of the economy that makes up most of US activity. The previous reading came in at 54, down slightly from 56.1 in February, suggesting services activity is cooling as businesses adjust to higher oil prices and disruptions tied to the ongoing Middle East conflict. We'll be watching closely because services strength has been a key pillar of consumer spending and corporate earnings, and any meaningful slowdown could shift expectations for the Federal Reserve policy. Friday morning, May 8th, delivers the latest Canadian jobs report. The unemployment rate has been holding steady at 6.7%, just below the 7.1% peak we saw last fall. Recent reports have shown modest employment gains driven mostly by part-time work, while youth employment remains very elevated at 13.8%. We pay close attention to these numbers because employment trends directly influence consumer spending, housing, and the Bank of Canada's interest rate policy. That same morning, we also get the US employment report, where unemployment recently fell to 4.3%, down slightly from 4.4%. While the lower rate looks encouraging on the surface, it actually reflects fewer people participating in the labor force than the strong hiring suggests. While total employment is slightly down. We'll be looking past the headline number to understand the true underlying health of the labor market, since these dynamics shape both the Federal Reserve policy and the spending power that drives corporate profits. As always, we remain focused on what matters the most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you next week.